Daljeet, hi, afternoon. What is it that you're making of this acutely volatile nature of the markets nowadays? Best to lighten positions ahead of the June 4th event?
Good afternoon, Aisha. See, we as in long-term investors, I think we best thing for us to do is not to do anything. That's not doing anything is also an activity in the market. Why? Because we believe that this kind of turmoil is only because of this major political event, which is due now in next few days. And probably for the traders, it may be of relevance because every day they will keep on taking calls on how many seats are coming, who is not coming, what is happening. For us as long-term investors and to see, which will see a long-term durability of policy action, I think we are not expecting anything changing there. Our view is very clear that whether majority margin of victory, whatever it may be, but ultimately if the current dispensation continues and the policy continuity remains, then there is nothing to worry. Then we have all the growth aspects in line, and whatever was the earlier contention of India doing very well for next 2 years, 3 years, 5 years, all that remains. So there's no change. So even if there is because of this volatility, because of this margin of victory changing here and there could be a turmoil for one or few days, and then it will come back. So we are going with that view, and therefore, as a disclosure also, we are not doing anything in our portfolio. We're just sitting tight, looking at day-to-day gyrations of the market.
Good strategy. Don't do anything. Just sit tight on the portfolio, and perhaps just patience is going to pay out quite well for you. But the other one on our radar today is UPL. The numbers were just out in the matter of last 1 hour. It was a big beat versus expectation, and the numbers will come up for you shortly. The revenue profile of 14,000 crores was much better than our expectation of just 12,000 odd crores. The margin has come in at 13.7%. And going forward, the company is guiding for 4 to 8% growth in revenue, which sounds fairly modest. But I think it's the EBITDA growth which is expected to be almost over 50%, and the fact that the cash flow generation is going to be strong, those numbers for you on the screen, that's the big talking point right now. Daljeet, over the course of last 3 to 4 trading sessions, we've already seen UPL move up almost 15 to 20%. What would you do now for UPL and the rest of the chemicals pack as well, if you have a view?
So instead of talking on UPL, I'll talk about agrochemical sector. I think in last few interactions we had discussed about it, that we were preempting this kind of recovery in the agrochemical sector, and we were of the view that probably the worst is behind for this sector. If it is not fully behind, maybe next one more quarter, things will turn around. So we have seen some other few other smaller companies also coming out with numbers. They have also shown sequentially there is a good change. Of course, YOY there will still be negative numbers because the base was much bigger. But the point is that there is a very clear signs of recovery happening in the sector, and we feel that maybe next 1 or 2 quarters, this issue of China dumping too many goods at very low prices, that problem will get over. Demand will also revive, and in the view that the domestic market also will revive because of the expectation of good monsoon. After El Nino, if La Nina comes, then that normally results in very good monsoon, and that leads to good demand for all these agri chemicals. So we are positive on this. Some of these stocks we are holding in our portfolio. Disclosure, of course, UPL we are not holding, and we don't talk stock specific. But on the sector, we were preempting this turnaround to happen. I think there are some green shoots of that.
Okay, in fact, we had a whole host of managements as well chat with us today, from Sirma SGS to Sapphire Foods, which has been under pressure on the back of its earnings, and of course, Polycab as well, along with Dr. Lal. So let's hear out a slice of the management interactions from all of these.
Going forward in the coming year, we would be in a better position where we are guiding a growth of about 40-45%, same as per last year, and EBITDA margins to stabilize at about 7%. In the coming year, FY25, I expect my consumer business to be below 40% of my revenue. Currently, it is 40%. Automotive would be about 21%, industrial about 25%. Healthcare would constitute 8% of the higher sort of top line growth. So it would be led by, as it has been in the past, by industrial, auto, and consumer.
So soft demand conditions and heightened competition is what makes this quarter also a little constrained. I think we might see this for perhaps another 1 or 2 quarters, and then we will see an improvement in overall demand conditions. That revenue should grow in the region of 25%. EBITDA should grow in the region of 30%. You'll have quarters and years when it might be a little up and down, but I think that's the longer term aspiration, undoubtedly.
I think the overall competition scenario, some bit of the maybe irrational pricing that was seen intermittently has subsided a bit. So we've been consistently saying that, our EBITDA margin level would be around what we even see, in our delivery in Q4, in the range of 26, 27% kind of EBITDA margins. I think that's something which we continue to state is something which we are working towards.
Now pickup is done in the fourth quarter of this year. And now this coming 3-4 quarters is going to continuously grow. And we are looking very positive in that because range we increase and we have seen that what is the really demand in the market. We understood everything from last 3-4 quarters and now we are on the right place.
We are confident of our profitability. As you would have noticed, we had almost 10% of PAT margins. We believe we have a sustainable 12 to 13% EBITDA margin and will continue to maintain that in the quarters and years to come.
AB Capital, that's the healthy number currently on your screens. Their total AUMs have seen an uptick of 21%. PAT, and including the minority interest and excluding the one-off item, that's seen an uptick of a solid 33%. 812 crore rupees is what they've delivered this time around. The revenue as well has seen a growth of about 32%, and I guess that is what the street is liking right now, which is why that spike up after the numbers that came by. The health insurance business also has turned profitable on a sequential basis. So clearly the nitty-gritty is not just the operational numbers, but that also seems pretty healthy for AB Capital. Kunal, you've liked some of these stocks in the past as well, right? What do you see on the charts now?
Yeah, I think it's still looking very attractive. In fact, in this last phase of correction, in the last 10 odd days, the stock had come back towards from 245 to 50 levels to almost 210 to 15 odd marks. So that was a good retracement for a stock like AB Capital. And in the last couple of days, the stock was showing a lot of strength and resilience. So, if, for example, on Friday, the stock closed on a positive note, and today the stock opened with a strong follow through, did not manage to break below the Thursday and the Friday swing lows as compared to the indices as well as for many of the mid cap peers. So I think that itself is a sign of strength for the stock. I would believe that now we could be on course of coming back to that 240 to 45 mark, possibly in the next 2 to 3 weeks.
Okay, point taken. The two pockets which are making news right now is, of course, industrials, with the earnings coming in from ABB. Both ABB and Siemens are actually higher, anywhere between 7 to 10%, actually 7 to 11 now. And on the other hand, the auto companies are coming under pressure, especially Tata Motors, with the kind of miss that we have seen in the margin of JLR this time around. And going forward as well, the outlook is not very healthy. Daljeet, from these two pockets, autos as well as industrials, what would be your recommendation? Should one still buy afresh into industrials and prune positions in automobiles?
No. So in fact, in automobiles, we are quite positive. We don't play OEMs directly because by nature, they are all large companies and mega cap kind of companies. So they don't fit into our theme of mid and small cap. We play that auto theme through various ancillaries. And normally we choose ancillaries which are present in 5-6 sub-segments so that it remains diversified. It is not overly exposed to any one segment, either two-wheeler or four-wheeler or engines like ICE engine or electric engine. It should be across the various segments. So those kind of ancillaries, we have exposure to 3 of them. And we are positive on the entire sector also. So as the OEMs do well, these ancillaries will also do well. On the capital goods, again, the same thing. We don't own these large names because, again, they are all highly overvalued as well as big large caps. So we again have to look for something which is a smaller company or mid-sized company and which is in the similar field. So we are again positive on mid-cap capital goods companies also. And we believe that abhi to capex cycle has not even started. So if once the industrial capex cycle starts, which everybody has been expecting for quite a few years now, let's hope that after these elections, like there is the big announcements of policy, etc., will come, and then probably we'll see some kind of revival in that industrial capex. That time, I think most of these smaller and mid-cap companies should also do well. So one has to choose these companies very specifically and play according.
That's the take coming in on some of the capex themes names. But Naresh, what's your sense on Tata Motors, which of course has seen a sharp earnings reaction today? M&M ahead of its numbers is also a little somber, although it had a great last week and has had a great run as well. Would you say that autos may head in for a pause perhaps?
So some of the names could get into a pause. If you look at Tata Motors, it broke out at 400, 450 levels last year. The stock has gone up all the way to 1000 plus. So that's been a huge rally, and a correction of 10-15% from the top would be very normal. We saw that happening with Mahindra and Mahindra when it had the big rally in 2021. So out here, correcting at 900, 950, and that should be a zone of support where it should pause. Same is the case with something like a Bajaj Auto, which has done a lot, could consolidate. But something like Eicher Motors, which has just broken out a few weeks back, may not correct a similar manner. So that should be a buy on a dip, and it has not gone up in a major way. So the sector is extremely strong on longer term trends. In some of the cases, because the price moves have been very large over the last 3, 6, 12 months, consolidation and correction of 10-15% from the top would be okay. So one could be looking at switching from some of the names to something like Eicher Motors or Ashok Leyland on declines.
Okay, point taken. So that's a view coming in on some of the auto majors. But we did hear out the management when they spoke with the investors on the con call as well. Listen into a slice of that conversation with the Tata Motors management.
Currently, internal teams are working away in terms of drawing up the entire plan. And the next step that we need to do is to put up a scheme of arrangement which needs to be put up to the board for approval. I would expect in the next 1-2 months the scheme would get approved by the board, and thereafter I would expect maybe another 8-9 months for the NCLT process to complete. April next year we should try and get this concluded. Worst case slips to July. Yeah, we're about 55,000 units now. Sanam too started the operations. We're producing about 8,000, 10,000 in that site now. That will keep increasing. As the year progresses, I would expect to take the 65, we'll take it up to about 80,000 units.
Okay, let's focus in on Zomato. And while that may be headed a little bit weak into its numbers, but that is not what the expectation is surely from Zomato. I'm just going to bring up the poll as well for you. Maybe we can line up Vinny as well and try and highlight what the anticipation is from Zomato. Because we're expecting the food delivery business to actually see growth trends, and that it's going to continue, aided by, of course, the increase in the platform fee that they undertook in this particular quarter. We're expecting Blinkit's GOV to show a growth of nearly about 12% on a sequential basis. In fact, let me take it across to Vinny and find out what are the operational numbers that she's penciling in her poll.
So Zomato is expected to report its numbers. When you look at it in terms of numbers, revenue is expected to see a growth of 11%, profit a growth of around 38%, while in terms of the EBITDA, we're expecting a 37% growth and improvement in terms of the margins, a sharp improvement in terms of the EBITDA margins. This is all we're comparing on a sequential basis. Food delivery business, that's expected to see a strong growth. That strong growth is continued to trend upwards. Why? Platform fees, that's what they've taken a hike, and that is what will be supporting the growth of the food delivery business. So yes, sequentially, food AOV, that's the average order value, that could remain flattish. But other than that, we are expecting a good performance in the food business. We're expecting Blinkit's gross order value to show a growth of around 12% quarter-on-quarter basis. And let's not forget, they were talking about the EBITDA margins. When you are talking about the EBITDA level, a margin, they were expecting that to be on the positive side, achieve a break even over there as well by Q1 FY25. And analysts believe that maybe they could surprise the streets if that happens this time. So that's what we're keeping keeping an eye out on in terms of the commentary. Growth is expected both in Blinkit as well as Hyperpure business, strong growth over there. So let's keep an eye out on that. Will the company be taking any more platform fee hikes? That's something we'll watch out for in the commentary, and any update in terms of the trends that we're seeing, that's key factor to watch out for.
Okay, thanks, Minnie, for that. But time now to take the CT picks from our technical experts, closing trade ideas. Naresh, you go first.
That would be a buy on Tata Steel. The stock has seen a good recovery in the day from an important support zones wherein it had given a breakout about that 157 to 160 mark. Strong recovery, relative strength as well, and it's given a longer term breakout. 155 was the top back in 2021. So expecting this to continue towards 170 and cross into new highs.
Okay, point taken. So that's the closing trade idea coming in from Naresh. Kunal, what are you spotting on the charts?
So I'll go with Asian Paints, a stock which over the last 5 days has shown a very heightened amount of volatility from 3,000 to 2,700, and from 2,700 the stock has come back towards a 2,800, 2,850 level currently. So looks attractive at current stage, and expecting the stock to have formed a major bottom for itself.
Okay, point taken. As we head into a break, take a look at the stock of CE Infosystems. I think in the last few minutes there has been quite a bit of perk up on that one. At least that's what's visible on my screen. CE Infosystem is the stock that will come up for you on the screen, and the other one is Hindustan Zinc. So not really showing on the charts there, but Hindustan Zinc, that's the other one. That's higher by almost 4 to 5%. Time now to slip into a very short break. Don't go anywhere.
If you like this video, then like, share and subscribe to ET Now.